Hi everyone, welcome back to my channel. So today's video will be a Q&A of some of my most commonly asked questions. Of course, y'all know I mentor traders, so I wanted to make a dedicated video covering the recurring topics that are brought up most often. So let's just go ahead and jump right into it. Y'all can see I have Apple pulled up here on the option chain. So I want to go ahead and start with one of the first questions every trader asks, and it's a signal of misunderstanding on how liquidity and order flow truly work. Now, typically for new traders, they may ask, why does the trade start red before it goes green, even when selecting high probable trades? Now, my answer to that is varied, but typically it falls under two categories. One being the expiration date selected, aka the DTE, and the other being the strike prices. Now, in some instances, when traders do the work and they evaluate their trade properly, they tend to believe that instant validation is the main thing to focus on. But as I always like to mention, the market will always test conviction. So when you enter, your order adds liquidity. That means the market needs to fill your position before moving in your direction. Now, market makers and algos exploit that liquidity pocket, and it can test your patience. So some main things to consider are when you're looking at the option chain and you're selecting the days to expiration, you definitely want to ask yourself a few questions. One is the priority on how long you plan to hold the contract, because obviously that will dictate the DTE as far as what you select. But it's a lot more complex than just that. And what I mean by that is that you want to make sure you have clues for advancement, which means you want to learn how to read price action and the wicks. Because as y'all know, they tell you the full story of where institutions are loading liquidity. So if you understand that, most good trades start with the short-term heat, and you can stop panicking and start managing with structure instead of emotion. So let's say, for example, you're interested in holding a contract for a little over 6 months. Now with the swing trade setup, you have to make sure everything is going to align to your plan, because one mistimed step can cause the whole contract to fall apart if you're not well versed in what you're selecting. And what I mean by that is, if you're seeking to trade within the money, then you should certainly know that your contract will automatically have intrinsic value. However, if you're selecting out the money contracts, it's good to know that there is no intrinsic value in your contract to start. Now, why this is important is because this can dictate whether or not your profitability is reached in a timely fashion, or if it will take extended time for it to get there. So let's say, for example, you have an ROI goal set to like 100 or 150%. Realistically, it's all about timing. Because the market does not stand still and it doesn't wait, you have to be prepared for the best move possible. So whether you're selecting a contract at, let's say, the 250 strike here, it's not just necessarily enough that you just have to consider that you're paying over $3,600 for the contract. The option Greeks, of course, play a part as well, but y'all have heard me talk about that several times. And open interest and volume are also factors to consider as well. You also want to make sure you always take into account the implied volatility. And then more true than anything, it's imperative that you understand how the stock or ETF that you're trading performs. So with Apple here as the example, we can see that the triple M is listed as a plus or minus $3.31, either to the upside or downside. Now granted, this is on average, and it is just a rough estimation. There's no guarantee. So what I mean by that is that you want to set realistic expectations on how the stock will perform. So regardless if you're setting a specific percentage or a dollar value for your ROI, the expectations have to align to what the stock will actually do over time. Because even the most liquid stocks can actually go against you if there's any level of instability in the market. Now this also ties into timing as well. Seasonality is a huge piece of this, because certain stocks perform better in certain quarters than others. So all things considered, it's definitely important to take into account all the factors that make up a quality contract. So if you're in the money, at the money, or out the money, just be sure to analyze all facets of the trade. Okay, so the next question I get asked pretty often is, how do I know when to enter or exit a trade? Now, obviously, this isn't a question that I can answer with one direct response, because every trader is completely different. The main key is identifying objective, repeatable exit criteria that matches your style of trading. Because what I've noticed is that most traders don't lose a ton of money because of the bad entry, they lose because of poor exits. So it could be anything from exiting too soon to cut your growth, or exiting too late, which destroys the risk to reward symmetry. If either of those apply, then it's very difficult to be a profitable trader. So with that being said, I do recommend using the ATR as I've mentioned before. The average true range will help you identify specific areas as far as how the stock performs over time. And you can use that to set a specific benchmark on where you want to enter or exit a trade based upon supply and demand or support and resistance. Now, there are some traders who don't adopt that style of trading and they actually just trade momentum and price action purely. And to that, I always say it's important to analyze the four market phases. So essentially, there's core cycles every chart moves through. And just to give a quick summary of what those are, the first one, of course, is going to be the accumulation phase. This is where institutional buyers quietly build positions after a decline. Now, price action moves sideways with low volatility and with low volume. Now, smart money enters before public sentiment shifts. And then the next phase is the rally. Now, this is when momentum starts building as demand outweighs supply. Now, higher highs and higher lows form, the trend becomes visible, and retail traders begin to enter as confidence grows. Now, the next phase, of course, is going to be distribution. This is when large players start selling into strength while retail continues buying. Volume may also increase, but progress is slow, and price forms range-bound patterns. And with that, market sentiment remains overly bullish even as momentum fades. And then lastly, the fourth phase is going to be the sell-off. This is when supply overwhelms demand, leading to a sharp decline. Now, lower highs and lower lows dominate at this point. And in a lot of cases, fear replaces optimism and traders begin planning, setting up the next accumulation cycle that is to come. So each phase transitions through psychology and, of course, by understanding the function of liquidity, not just price. Meaning, learning to read these shifts through the volume, volatility, and structure is what gives traders the real advantage in the market. So if you're ever wondering about when to enter or exit a trade, always consider the probability curve. Once you master when not to add, you start compounding your results in a positive direction. And that can be attributed to just understanding the market phases. Now, another question that I get asked quite often is why am I losing even when I'm right about the direction? And again, I went into detail about this in my last video, so I'll leave a link for that down below. But this question exposes one of the most misunderstood concepts in trading, and that's simply the fact that being right is not enough. Structure is what pays. In my last video, I did mention the fact that poor sizing, the wrong expiration, or impulsive timing will dictate whether or not the trade structure is right or wrong. So the quick tips are that you never want to enter too early before confirmation, and you want to be aware of the specific areas of support and resistance where volatility may compress. And also, you want to be sure that when you do select your contracts, you're not trading with such short DTE that you let time dictate you erode faster than the actual delta will. Because if it does, that price will cut into profits at an accelerated rate, and it can make any contract go against you quickly. So y'all already know I like to talk about symmetry. Your risk to reward ratio has to make sense, especially if you have potential large moves. So keep in mind that directional accuracy is worthless without that ratio in place as well. Okay, so another question that I get asked pretty often is what are the best time frames for day trading? Now, many people seem to ask this as if there's a universal answer, but the truth is the time frame that you choose is what you're most comfortable with and based upon what you have for your strategy. Also, it's good to analyze multiple time frames because this then dictates that you'll have more room to see the candles from different perspectives. Now, scalpers typically thrive on anywhere from shorter time frames like the 1 all the way down to maybe like the 30-minute. But that pace can expose noise and false signals because by default, you don't have as much room for error on smaller time frames. So be very selective. Swing traders, on the other hand, may prefer 15 minutes to like all the way down to the hourly, the monthly, weekly, or even yearly. And this just allows for the charts to have the trend context in full alignment. Now, why this matters is that your time frame must align with your assessment of the market sentiment and the anticipated direction. So if you're impatient, longer time frames will save you from overtrading in some cases, but not all. But if you're hyper-focused, shorter ones can give you faster opportunities, but in some instances require a little more discipline. So I always recommend that traders try a multi-time frame approach. So you can use higher time frames to define any type of analysis that you have. It can be like for trends or any type of like consolidation. And then use lower time frames to refine entry, so on momentum or breakouts. And then when both align properly, probability typically rises. So you'll tend to see a higher success rate when you use a combination of different time frames. Okay, so now the next question I get asked pretty often is how much should I risk per trade? Now, this is totally dependent on your starting capital. Everyone will have a different outlook on this based upon what they're willing to risk and how much they plan to gain. Now, the wrong approach is to always decide that you want to trade dollar amounts in every single trade. The correct approach is thinking in percentages of total equity. So remember, we're talking about ROI. So the reason I say that is that if you only ever set a dollar amount you want for a trade, you may be a bit more stubborn with sticking to that exact amount before leaving a trade. And from experience, I've seen so many traders who stick to a certain dollar amount and refuse to budge, and it ends up costing them money or the trade altogether just from not being willing to exit before the targeted amount is reached. And honestly, that's not even greed talking, that's just the fact that some traders like to stick to what they've already established as their goal without fully realizing that the market is not that forgiving. So sticking to anywhere from like 10 to 25% on a trade is pretty typical because this means that if you win or lose, you're still financially positioned to take the next trade confidently because you haven't risked too much of your money. But remember that risk isn't just how much you'll lose, it's also exposure overlap. So if you're in multiple trades tied to the same sector or index, your real risk might be 3 to 4 times higher than you realize. So you never want to double down on a wrong trade. That's why you always hear me talk about diversification. It doesn't just apply for dividends and building a portfolio, it also is applicable to options trading as well. So an advanced layer of understanding is to incorporate what's known as EV, which is the expected value, into your structure. Because if your EV is positive, you're mathematically positioned to win long term, so it's always to the best benefit to evaluate this with how the market behaves. All right, so the next question that I get asked pretty often, I said I was going to reference back to it later, and it's essentially how do you choose the right expiration? Now, this question for me reveals the gap between trading direction and trading time. There's a big difference between the two. Now, some new traders buy too little time, chasing cheaper contracts that decay before price even moves. So when you pick an expiration, you're declaring not just on where the price will go, but when. So a good guideline for this is for directional conviction plays, longer expirations for like leaps. They let you manage without panic. And if you have to, take a step back and make sure that you always study the implied volatility because this provides the term structure. It shows how time and volatility pricing interact with each other. And if you're unsure of how this works, I'll leave a link to a video where I discuss how choosing expirations that offer movement without decay dragging is super important for your contract selection. Okay, so in addition to that, there is another question that goes with this hand in hand, is how do I develop a trading plan? Now, for the most part, every trader can explain the type of trader that they are, whether they want to trade momentum, volatility, if they like to ride the trend direction, or if they're a counter trend trader. They even can typically identify the indicators that they like to use that validates their trade decision. But some have a hard time with identifying what makes their method profitable. And to that, I always explain that the market will expose the gap pretty fast. So anything that you're lacking within your trades, the market will tell you very quickly. So even if you figure out your favorite method of trading, such as like breakouts or reversals, be sure to track which perform best by time of day, the range, and the volume profile. And you can focus on the top two that outperform the rest. And if you need to, go ahead and ignore any other strategies until you perfect the one that you feel most comfortable with. And that can definitely help you be more precise in your selections. Now, with that, anytime you're analyzing the charts, if you're a new trader especially, you don't want to become a victim of signal confusion. Because anytime you're evaluating the candles, you want to look for potential setups with confirmed reasoning that is actually logical. So it's not enough just to see a pattern, because you can miss the context completely. And what goes hand in hand with that is the emotional control that's always needed anytime you enter into a trade, because that's what separates skilled traders from beginners. So another good recommendation is to always find what category of setups is failing you, and then single that specific strategy out. This will help you build awareness metrics, because this all will impact the execution of your trades. Now, early on, it's easy to confuse bad trades with bad outcomes, but there is some differences between the two, because one losing trade can be a good decision with a poor result. And that's why I mentioned that it's important to understand that distinction preserves your discipline. So all in all, y'all, all these questions lead me back to one truth. I always look back to when I first started trading and when I first learned how to analyze the market. The questions that I had then were more reactive than they were understanding of the principles of trading. So it was important for me to understand that I should never force trades, trade with structure, of course, because that's always going to be your purpose behind it, and then to treat risk just like currency. And once that shift happened, that's when growth became measurable for me. So yeah, it may take time for that to be the case for you, especially if you're brand new. But just don't get discouraged. I know there's so many different facets to this and so many layers. But keeping consistent and just learning how to read the charts will always play in your favor in the long run. So yeah, y'all, that's pretty much all I wanted to discuss. And with that, that'll pretty much do it for this video. If you found any of this information to be helpful, y'all already know, feel free to leave me a comment down below. As always, I thank y'all so much for watching. And of course, I'll see y'all in my next one.